All right, in today's lesson, we are going to talk about accounting for sales on account. We are selling goods, not services, but goods to a customer with payment expected in the future. So we may offer the same terms like we talked about in the previous chapter of 210 and 30 or whatever we want to do as far as selling to our customers. And again, assuming our customers might be a lot of them might be retailers themselves, and we're just maybe producing goods or something like that, and they are in turn selling them to the end user or the customer. All right. So we're going to talk about the relationship between the accounts receivable ledger and its controlling account. And this is going to be really familiar to you because it's going to sound very much like the conversations we had in chapter 9 about accounts payable and a subsidiary ledger. So you know what a subsidiary ledger is. You know what we also call it a subledger. It's going to be very similar to that with a few little tweaks in between, and how we're going to record sales in something called a sales journal. So every transaction where we sell product on account or with credit, we are going to record that in the sales journal. We're going to talk a little bit about sales tax as well, something called markup. Few little new terms for you to digest here. First of all, one thing we have to keep in mind is recording revenue. Recording revenue. Regardless of when a payment is received, the revenue should be recorded when a sale is made, not on the date cash is received. Again, we are operating under generally accepted accounting principles, GAAP. We are utilizing accrual basis accounting, which means we're matching expenses against the revenue when it is earned. And in our case, we record revenue as earned when we actually sell it at the point of sale, not when payment is received. So, for example, today is January 18th. How convenient. If we sold it on January 18th and the date it was paid was February 18th, we're going to record that sale. We're going to realize the revenue, record it on January 18th. Well, what happens if we sell it on January 18th? Maybe we make a cash sale, a little bit different than our on account that we're kind of focusing on here. But if we sell it on January 18th and it's paid for on January 18th, doesn't matter when it was paid for, we record the sale on January 18th. Now, there's some situations, and I remember Clicker Strawberries. I was with a guy and he was delivering strawberries to a bunch of different grocery stores in the Spokane area. And we hopped around and unloaded this refrigerated truck full of strawberries. And I asked him, I said, so are these fairly popular? And he said, do you know when these strawberries were paid for? Like, no. He said, 3 months ago. The customers wanted them so bad that they paid for them in cash 3 months in advance. So in that case, the payment for the goods was made long before the delivery was ever made. Doesn't matter. You record revenue on the date it's sold. So I give this example. What happens if we sell it on January 18th, but our customer prepays for the product well in advance, and then we ship it later? Okay, we record the sale on the date it's actually sold and the date it changes hands. There's a legal transfer of ownership. All right. So you got to keep that in mind, realization of revenue. And again, that matching principle of matching expenses with revenues. Drag this out of the way. Okay. All right. So let's see, moving on here. A couple of terms here. The amount of business received from the sale of an item of merchandise is called the selling price. That's the price we get for selling it to either an end user or to a business who then in turn is going to resell it. Whatever the case, they are that would be our selling price. The amount of businesses add to the cost of merchandise to establish a selling price is called a markup. Let's say I'm a reseller. I'm going to slide this over here. Let's say I deal in resold goods. No, hold on here. Here we go. All right. And I've got some items here, and maybe like some stores, I don't actually make the product. I just buy it, and then I turn around and resell it. So if I'm selling a t-shirt and I pay cost of merchandise, I'm paying maybe the manufacturer, Abercrombie, something like that, $25, and I want to mark it up. I should actually say selling price to be consistent with our example. And I want to mark it up 40%. I'm going to use a little Excel ease here. I would say equal my cost of merchandise plus parenthesis 100% of the original price plus 40%. I'm marking it up for its original cost that I paid for it plus 40%. So the one is its original cost plus the 40%. That would be a markup. So if I was to mark up an item, I paid $25 for it. I'm going to turn around and sell it to my customer for, whoops, I'm not going to sell it for that, right? I'm going to sell it for $26.40. Let's get my formatting correct here. All right. I marked it up 40%. That is not correct. I should say times B2. I'm going to say that doesn't sound right. B2 times 1 plus. You're probably looking at me going, what are you talking about? Okay, yeah. That would be $35. That makes more sense. All right. So I paid $25 for it from, say, the manufacturer. I'm going to turn around and sell it to my customers for $35 after a 40% markup. I realized I could copy and paste that formula. Let's do that again. I'm going to take my original price times 1, the original price, plus my markup. Now, in this case, I'm reselling tennis shoes. There seems to be a high profit in tennis shoes. I paid for it, maybe from an overseas producer, something like that, $80. I'm going to mark it up 100% from its original price that I paid for it. I'm going to turn around and sell that to my customer for $160. I marked it up 100%. Its original price plus 100%. Let's do one more. I got some gym shorts. I'm going to say I'm going to have $12 times 1 plus 1, the original price, plus the markup gives me $19.20. So I paid $12 for it because, again, I've got to make a profit in this resale process. I've got to pay my employees. I got to pay the lights. I got to pay for the building. I have all these expenses. So I'm paying my cost of merchandise for paying for it. If I'm a reseller from the manufacturer, I need to make a profit. We call that gross margin. I need to make a profit in that process. So that's markup. Okay. Selling price, markup. And then we get into the Accounts Receivable Ledger. Hold on a second. I got to do a reset here. I'm kind of wonky. All right. Let's see. Where did we go here? I kind of went too far here. An Accounts Receivable Ledger is a subsidiary ledger containing all accounts for charged customers. Okay. And you're familiar with this with accounts payable. Now, instead of having an individual account in our general ledger for every one of our accounts receivable customers, which we did way back when with Delgado Web Services, we had a general ledger account for every one of our customers. If a business is large enough, we're going to say, no, that's going to be like a waste of time. All right. We're going to create a subsidiary ledger, an accounts receivable ledger. We have a separate ledger page for every one of our customers. Same thing as we did with accounts payable, although now we're on the accounts receivable side of things. All right. Just like we did before. Now, sales tax, chat about that for a moment. Sales tax, a tax on a sale of merchandise or services is called a sales tax. Now, let me show you something here that I gleaned from my travels. Probably wondering, well, how much is sales tax? Well, I pulled this thing up over here. In Walla Walla County, College Place, we have a sales tax of it's actually 8.7% or 0.087. And you're probably wondering, where does that money go? Well, 6.5% of it, 0.065, goes to the state of Washington. All right. The other 0.22 goes towards Valley Transit, street repair, extra police coverage, juvenile justice system, all these things that voters, it's gone before the voters, they have to approve an increase of sales tax. Walla Walla has their sales tax is actually 0.089 or 8.9%. Theirs is a little higher. I think it's because of extra money for road repairs, a 0.2 of a percentage point. Okay. All right. So that's sales tax. And by the way, where does the sales tax go after you pay it to, say, Walmart? Well, periodically, Walmart they're collecting all that sales tax from customers. They have to send a report to the state, to the Department of Revenue that says, hey, we sold this much product, we collected this much sales tax, and they have to write a check, usually like a wire, an electronic payment, to the Washington State Department of Revenue for all that sales tax they collected. So at the point of sale, at the point they collect that money from the customer, it becomes a liability. They can't keep that money. All right. And so the money actually goes to the State Department of Revenue. And then in these local taxes like College Place 0.022 or 2.2%, that money gets sent back to that particular area, the city of College Place, to do whatever they want to. And so College Place, by the way, was really smart to get Walmart and Home Depot within their boundaries, because they are collecting all of that sales tax and using it to better their community. And none of that money is going to the city of Walla Walla, even though most of their customers are probably coming from Walla Walla. Okay, so that's like smart business there. Okay, so there you go, sales tax. So here we have a subsidiary ledger. I'm just going to pause just for a moment here. Time out. Okie dokie. Continuing on here after some technical difficulties. All right. So here is our subsidiary ledger. All right. Again, we have an account for each one of our charge customers. They're using a 3-digit coding. Number one being just showing it's an asset or related to accounts receivable, and the next 2 digits kind of unique to the customer. And like we did with accounts payable, the total of all of our customers will roll up to the current balance on the debit side, increase side, asset of accounts receivable at any point in time. Remember, we did a schedule of accounts payable in the last chapter. We'll do something similar here with accounts receivable. So again, same concept, only now it's the asset side and it's our customers we're keeping track of rather than us keeping track of our vendors. All right, flip side of things. All right. So let's see, moving right along. Of course, debit side is the increase, credit side is the decrease for accounts receivable. And now here we're setting up our ledger, our accounts receivable ledger page, Skinner College, the beginning balance, check mark and post reference. Maybe we're setting them up for the first time. All right. Except notice the difference is we have a debit and we have a credit, and we just show debit balance. So instead of the traditional general ledger like we have down below here for accounts receivable with a debit and a credit and the balance of debit and credit, we should only ever have a debit balance or zero in our accounts receivable ledger. Now it's possible, I've seen it before, to have a credit balance there. You would just show a negative debit balance where your customer maybe overpaid you and you actually end up owing them money. All right, so that's actually more probable with accounts receivable to have a negative balance than it is with accounts payable where you would overpay your customer, I mean your vendor. That would be weird. Okay, so now let's say 99% of the time you're going to have a debit balance in your accounts receivable ledger. Okay, all right, and of course this saves a lot of time by having this information here. Okay, and again we have an account, we have a general ledger. We have an accounts receivable ledger page for every one of our customers. All right. Same column headings, account name. We put the name of our customer, account number. Again, an asset is 1, 50 is the number we've assigned to the customer, date, balance, check mark, and the account balance. Okay, very similar to our accounts payable, nothing new. Now we get to the sales journal. Understand the sales journal is only used for sales on account, where we're selling merchandise on account, nothing else. And we have 3 columns. We have accounts receivable debit, sales credit, and then when we collect that sales tax, we're going to show that as a payable. I shouldn't say collect it. We're going to record the sales tax at the point of sale at the time that it changes hands. And when we record the receivable, we're going to record a payable because now we owe the state, in this case, some money because we sold some product. Okay, so this is your sales journal. And we could do this in a general journal, but we would have 3, every time we had a transaction, we would have 3 different lines in our account description. This saves a ton of time by just having those special columns set up. And notice we don't even have any general debit or general credit columns in our sales journal. It's just going to flow through to those 3 items. Pretty simple, all right? Here we have our sales invoice, and here we're recording, our subtotal, our sales tax, our grand total, how much the customer's got to pay us, what are the terms. We should be familiar with what 210 and 30 is by now. Pause. What does that mean? It means that my customer pays me within 10 days, they can take a 2% discount. Otherwise, they pay the net amount in 30 days. Okay? All right. And your sales invoice is going to be whatever your business needs for it to be. It can be as simple or complex that needs to be to meet your customer's needs. Now, you generally wouldn't have a sales invoice for cash or credit card sales. Those would be reported at what we call the point of sale. It would be like in a cash register or something like that, where they would get a sales slip for the sale. So when you walk into Walmart, you're not getting a sales invoice. You're getting a sales slip to show that you paid. Okay? When you walk out the door, sometimes they check. No, that's what they do at Costco, don't they? When you walk out the door at Costco, there's somebody at the door. It always checks to make sure that you've paid for all the items in your cart. All right, sales invoice. So a sale on account, we're going to record this. Here we have sold merchandise on account to Wells Apartment for $454.50. Okay, we're going to add sales tax of 2.5%. No, I don't know. How about 5%? 5%. We're going to add sales tax of 5%. I just had to do that math in my head for a total of $481.97. So the cost of the account, the sales price of the goods were $454.50. We added a 5% sales tax. Our customer has to pay us in the future at least a total of $481.77. Sales invoice number 498. Okay, so we would record that with a debit to accounts receivable, a credit to sales, and a credit to sales tax payable. Okay. So in our sales journal, we're going to put the date, the name of the customer, the sales invoice number. Notice it says sale number, so we don't have to say SI or anything like that. We would just say 498. We're going to debit $481.77, the price of the goods plus the sales tax. There is the sales amount that we record the sale. We don't record sales tax as part of our sale. We record that as a separate payable that we have to turn around and pay the state later. Okay? All right, let's pop back to just really quick though. We're saving a ton of time by using our sales journal. Okay? Again, we're recording the sale at the time we sold it, not necessarily when it was paid. It'll be paid in the future. Again, that realization of revenue, we record the sale at the time it changes hands to our customer, not necessarily when it's paid. Now, if sometimes you have a customer that's tax exempt. You might have a customer that is a nonprofit, or they are a state or government entity or whatever, where they are not subject to sales tax. Some customers also purchased items for resale. And oftentimes, if they purchase items for resale, they would be getting double taxed. So they might sometimes when it's for resale, they can have an exemption certificate or a resale certificate they will present to you, and they don't have to pay sales tax. Of course, if they live like in Oregon, they can present their driver's license. At least that's the way it used to be. All right, that kind of stuff. All right. So let's just check really quick here. Check out this sales tax here for a moment. So we had sales tax. This thing isn't playing nice in the sandbox. There we go. We have, I'll just say this is our sales amount, sales tax percentage. So if we had a sale of 450, by the way, I'm just doing this on the fly, so please forgive me here. We can put this as a currency. And we have this as a percent. And I think that was 5%. Okay. Our sales tax amount would be 5% times our sales amount, 2273. And I can already see that's not right. How about 5.5%? No. 7%? No. There we go. It was 6%. I had to back into that. I had to reverse engineer that. 6%. There we go. It was 27.27. Total invoice is going to be our sales amount plus our sales tax amount, 481.77. I'll call this my sales tax calculator. All right. Ooh, that was fun. I can even like do fun stuff and format that. I'll do that later though. 481.77. That's how we would record sales tax on that item. Just kind of, I had to reverse engineer that percentage though. Didn't do very good in my head. How are selling price and markup related? Markup is the amount added to the cost of merchandise to set the selling price. We went through some calculation to kind of show what our original price was, our cost of merchandise with a markup added to it. What is the relationship between the accounts receivable ledger and its controlling account? Well, as we did with accounts payable, the total of all the accounts in our subsidiary or subledger should always match the balance that we have in the controlling account, the overall account in the general ledger called accounts receivable. What column on the general ledger form is not on an accounts receivable ledger form? Well, that would be the credit balance because we only have a debit balance in our accounts receivable ledger. Okay. What is the title of the general ledger account used to summarize the total amount due from all charged customers? That would be accounts receivable. The monies that our customers owe us for product that we've already sold to them and they have yet to pay for. Now, you need to have an employee, somebody in your accounting department, to keep track of your accounts receivable and to make, check due dates. And if customers start getting near their due date, sending out a friendly reminder, or if they start going over their due date and they're late, now they're calling, emailing, connecting, some sort of communication. I remember I did that for a company I worked for. It was not a fun job, but one that had to be done. And I also wanted to make sure at all times that the accounts receivable subledger was accurate. All right, because there's some big bucks there for your company. Because if your customers aren't paying you, what are you going to use to buy your product and keep going in your business and to pay your employees and all that stuff? So you got to get the money from your customers to run your business. You can't just let it sit in accounts receivable, right? How are sales tax rates usually stated? As a percent of sales, as you're very well familiar with the many times you've bought stuff at Walmart, correct? Why is sales tax collected considered a liability? All right. Well, I'm recognizing that because I made a sale, that in the future I'm going to have to pay a percentage of that sale to, in this case, the State Department of Revenue for the sales tax. I've created a liability by selling a product. Whether I've collected cash yet or not doesn't matter. I have to record that sale and in turn record the liability for the sales tax that I owe. All right. So let's go to MindTap. I am in lesson 10.1 here. Lesson 10.1. Okay. And here we go. I have to have my calculator ready. All right. So first of all, Classic Appliances using an Accounts Receivable Ledger. On the blank ledger page above, locations have been identified with letters. To open a new customer account, indicate the location of each of the following items. The customer's Venice Cafe. The account number is 120. The balance on September 1 of the current year is $390.34. So I'm setting up an Accounts Receivable Ledger page. Where's my balance going to be? Over here in H. 0 blank. Well, my debit, start out with, I'm not going to have anything in my debit column. Excuse me, it's the word balance. Sorry about that. The balance would be D. Let's go back and do that. Balance, the word balance would be up here in item. Sorry about that. September 1, of course, would be my date, letter C. Venice Cafe would be my account, A. Check mark would appear in the post reference column because I'm not really posting anything. I'm just recording a beginning balance based on some history. The actual dollar balance is over here in my debit balance, H. Account number 120 is going to go up in, account number would be in B. And my second blank item would be the credit column. There'd be nothing in the debit or credit column to start out with. A, B, C, D, E, F, G, H. Looks good. Okay. Now we're going to record some sales in the sales journal. Okay, sold on account to Lenny Stanford. Now, do we have a tax percentage here? Yes, it is 6%. No S is needed in the sale number column of the sales journal. All right, so we're going to come down here, September 2nd. We're going to put in the name of the customer, Lenny Stanford. All right, sales number. No S is needed, so I'm going to put 221. All right. Now we sold it for $1,600. Let me get my handy dandy little calculator over here. We sold it for $1,600. We have a sales tax rate of 6%. So we're going to record sales tax of $96 for a total invoice of $1,696. All right. Record that. So $1,696 is going to be my accounts receivable debit. We actually sold it for $1,600. We have sales tax payable of $96. Okay. Now Washington City Schools is exempt from sales tax. So we're going to come down here. September 6th, Washington City Schools. Sales number 222. These are sequential. We sold our product for $680. We have a sales credit of $680 with no sales tax payable. Number 7, Venice Cafe. 223. Let's go back to our little handy dandy thing here. We sold it for $25.60. 6% sales tax. $153.60 is going to be our sales tax amount using my calculator here. Total invoice $2713.60. 2713.6. Wait a second. Yeah, that's correct. $25.60. Go back to my calculator here. $25.60. $153.60 was the sales tax payable that we have to pay later to a government entity. Then on the 15th, we've got Washington City Schools again, tax exempt, sales 2224, amount of $1849. no sales tax. Okay, looks good. Okay, we did that and we did that. Save and continue. All right, and now you're doing your own thing here. Fairly brief assignment. So again, you're going to do the specify what goes where on the accounts receivable ledger, and you're going to record 4 entries, which include what you need to add sales tax, which again is 6%, and you'll then record those in the sales journal. All right. Let me know if you have any questions. Thank you for watching. Have a great day.